The calls for increased corporate accountability and corporate responsibility are growing, but greater accountability between business, investors, and society in general can be difficult to achieve when we rely on business management approaches and corporate reporting models of the past. Businesses are often trapped in reporting processes that are short-term in focus, often only concentrating on the next quarter. So it could be very difficult then to even contemplate a sustainable future in such a framework. What's more is that most of the current corporate reporting is, by necessity, primarily backward-looking, where they focus on reporting past performance of the business rather than on describing its readiness or its innovative strategies for the future. Instead, they tend to focus on compliance and box-ticking approaches, which often views the financial elements of the business in isolation from other aspects. And this results in corporate reporting that is, one, complex, very long, and doesn't really capture the business's ability to create real value in the longer term. As a result, business leaders and investors aren't getting the information that they need, and capital markets are suffering from short-termism and an excessive focus on almost exclusively financial information instead of broader information which could better demonstrate how an organization is creating value both for the business and for society. Let's talk about integrated reporting. And to help us tackle this important topic, we're joined by an expert in the area of integrated strategy and sustainable finance, who will help explain what integrated reporting is, what it means for business and sustainable development more particularly, and what your organization can do to advance on its journey towards a more integrated and strategic approach. And as always, if you find this video useful, please don't forget to give us a like before you leave. We're also going to include a link to a free tool at the end of this video to help you better understand the principles of integrated reporting, so stick around for that. To learn more about integrated reporting, I've invited Cornis van der Lugt, an independent advisor specializing in sustainable finance and strategy, to join us to shed some light on this topic. Cornis has been active in standards development and delivering management education on sustainable business practices over the last 2 decades. A former manager with the United Nations Environment Program, he was deeply involved in establishing other initiatives such as the UN Global Compact, the Global Reporting Initiative, and ISO 26000. He's also been one of the leading trainers on the application of International Integrated Reporting Council's framework for integrated reporting, delivering training in various countries, including his own native South Africa. Welcome, Cornis.
Hello, David. Thanks for having me.
So let's launch right in. What exactly is integrated reporting?
The formal definition, David, is this is a communication that provides you a perspective on how your organization creates value over the short, medium, and long term. So this provides a more holistic and strategic perspective on organizational performance, and it really takes elements of your existing annual financial reporting and your annual sustainability reporting and merges these into what I like to call a synthesis report. The International Federation of Accountants refer to it as an umbrella report. And that new report, the integrated report, provides you a better focus on quality, materiality, capitals, and integrated thinking. Quality, improved, more decision useful information for investors, materiality, a more cohesive approach to reporting on what actually affects your ability to create value, and capitals, looking at diverse resources that your organization, your company is highly dependent on, and impacts and the interdependencies between these, as well as integrated thinking, which is about a certain quality of decision making about how your organization creates value over time.
So let me stop you there. You mentioned this concept of value creation. Is this the same as creating shareholder value?
This is not only about financial value and shareholder value. This is about more than just shareholders. It's also about other stakeholders, for example, employees, suppliers, the community. This is also a realization that value of the organization itself is driven by diverse factors, including intangibles, for example, the talent and the innovation of your employees, as well as indirect impacts. For example, those indirect impacts, social benefits or costs associated with your products and services. So the IRC's integrated reporting framework provides your company with a so-called value creation model that you can use to describe how you create value. At the heart of that is your business model and the value proposition. And then that model also sets out on an input and output side the different resources, or the so-called 6 capitals. These include human capital, intellectual capital, as well as social and relationship capital. And then if you look at it, you realize that how a company manages its employees internally is about talent management internally, as well as maintaining good social relations externally. And that again affects revenue and income. So this is all very interrelated. So a key message in all of this then is that value is multidimensional and multi-capital.
Right, so that's our view at 30,000 feet. But what does this look like on the ground in practical terms? How would you say differentiate it from current reporting or current corporate reporting models? Let me use an example of, let's say, a package delivery company. Let's call it SpedX. And if we look at SpedX's financial balance sheet, we can see that it owns a lot of delivery trucks, it has a bunch of planes and warehouses around the world, and all of this is already captured in its annual reporting on its balance sheet, which is duly verified by a top accounting firm, so that's fine. But if we're looking for how this company actually creates value, then regular corporate reporting doesn't actually tell us a lot. It may have millions of dollars in assets in the books, but at the end of the day, if it can't deliver a package in 48 hours, then the company's actual value to its customers becomes questionable. And its value then to investors is also going to slide.
That's correct. I mean, traditional financial reporting misses a big part of the value creation. So you can ask yourself, what are key resources that SpedX is highly dependent upon? Take, for example, human capital. Key is maintaining good labor relations. If that company has to deliver that package within 48 hours, it cannot afford to have a labor shutdown. So maintaining good labor relations, and the investor also needs to know how the company is maintaining good labor relations. For example, the results of employee engagement scores. Also, if you look at other resources that company is highly dependent upon in logistics, fuel. The responsible investor would want to know what the company is doing about efficient use of its vehicle fleet, what the company is doing about fuel efficiency. Also, what is the company doing to reduce the carbon footprint of its vehicles? And in the longer run, in how far is the company investing in a future of hybrid vehicles and electrical vehicles of different sizes? The key thing that the IRC highlights in all of this is that it's not just about producing a report on this performance then, it is more importantly about a certain quality of process. It is about, most importantly, the ability to display integrated thinking and a certain quality of management decision-making. The IRC framework then also expects your integrated report to include a statement from those charged with governance, taking responsibility for the report. And this sends a message to senior executives and board members. It challenges them to ask some critical questions about how that company creates value and what is the impact of that value creation process on society. Mervyn King often says you'd be surprised when you talk to board members how many of them cannot answer these very basic questions.
Okay, so what you seem to be saying is that a more integrated approach aligned to the IRC framework and specifically its value creation model would ultimately lead to a better analysis, like the board members that you just talked about, and better decision making for the companies themselves and for ultimately investors. So if you're a company and you're interested, you're listening to this and you're interested in adopting an integrated reporting approach, how do you get started? What steps can they take to move towards an integrated reporting and integrated thinking, perhaps more importantly?
I think, I can provide a broad overview that starts off in terms of three phases. First, preparing for the integrated reporting process. Secondly, creating an environment for integrated thinking. And thirdly, deciding on your level of implementation. When it comes to preparing for integrated reporting, companies usually start off by looking at their current suite of disclosures. And then you're looking at to what extent there is a disconnect or potential overlap between your existing annual financial reporting and sustainability reporting. Companies in this phase often also get an external consultant to do a gap analysis to determine in how far existing disclosures by that company is coming short of the requirements, including the content elements and the principles of the IRC framework.
So, kind of a side by side analysis.
A side by side, yes, comparison. And then in terms of creating that environment for integrated thinking, this is where your company moves over then to creating an integrated reporting team, which is an interdepartmental team, very critical. Here you bring to the same table managers from finance, investor relations, sustainability, communications, human resource management, etc. So this is an interdepartmental team, and companies that are now established and doing integrated reporting typically have the chief finance officer, the CFO, leading this team and overseeing the process. And that process is being enormously impactful and valuable, and experienced reporters will confirm that. The third element is then deciding on your level of implementation. The key thing is that this is an iterative process, right? So you're not simply going to do the ideal type integrated report in your first year. You can decide how you're going to apply the requirements and the principles over, say, a 3-year period. So what is the level of appetite internal with management for doing this type of reporting? And this is then a process of integration, and as well as improved integration between existing reporting processes that have often been managed in silos or in a fragmented fashion. The companies, as I mentioned, that are now experienced in integrated reporting will confirm that this is an incredibly valuable process. Potentially the biggest impact of integrated reporting to date has been that ability is to establish a more inclusive process internally. And this is confirmed by leading integrated reporters like SAP in Germany, ABN AMRO Bank in the Netherlands, Vodafone in the UK, Danone in France, Novo Nordisk in Denmark. In emerging markets like South Africa and Brazil, we see that the use of the multi-capital model is very useful in internal strategic decision-making about how the company can optimize its impact, and through that multi-capital value creation model, therefore also to more accurately determine how that company contributes towards the sustainable development goals. That value creation model that moves you to look at not just outputs, but also outcomes, the broader impacts, is incredibly useful in the emerging market context to converse about sustainable development goals. So ultimately, this is about creating an environment for integrated thinking to flourish within your business, which is a key feature of establishing those more sustainable businesses of the future that we all want.
Cornis, I'd like to thank you for your time and excellent insight. It's always a pleasure to speak with you.
Thanks for having me, David.
And for those considering a transition towards a more integrated approach in both your corporate reporting and your corporate thinking, You may want to begin by assessing your current reporting against some integrated reporting principles as a first step. And so we've created a tool for you to do exactly this. And you can access the tool in the comments section of the YouTube video, or we'll put a link on our website at www.interpraxis.com or Cornis's website at cornisvanderlugt.com. Thank you again.